According to Crash Bro Robert Kiyosaki, it's time to brace for stocks to nosedive and the U.S. economy to crater. In a recent tweet, the famous Rich Dad Poor Dad author said he doesn't trade stocks and bonds as he prefers more control over how his investments turn out. He also noted, yet too many signs point to a severe stock market crash. However, in his tweet, he didn't point to any specific signs, so I'm not quite sure what he's looking at. He further tweeted that if your future depends on stocks and bonds, please be careful. Possibly ask for professional advice. Well, that's probably not a bad idea anyway. But then he summed up his forecast by tweeting that he's afraid depression coming. Kiyosaki's statements stand in stark contrast to the performance of the S&P 500 index, which has rallied 17% this year, and the Nasdaq, which has soared 35% this year. And I remember previous warnings from Kiyosaki that never came true. But let's give him a bit of respect and see what the charts show. And we're now looking at a 20-year monthly chart on the Fidelity Nasdaq Composite Index ETF, and the symbol in the upper left, as you can see, is ONEQ, and this serves as a pretty good proxy for the Nasdaq. So as you can see here, we topped out in late 2021, came down here, and bottomed in late 2022, and we've made our way on up here. So I don't know what Robert Kiyosaki is looking at, but what I see is first we need to get to this level here, which may be an upside resistance as we move through. We need to get past that, and then the next resistance is this level here. So if I see any danger at that point there, it would be the double top. And we've talked about a double top many times. We'll be talking about a double top more here in the near future because the Nasdaq as well as the S&P are heading toward a potential double top. It depends upon how much steam is behind the market and if the market continues strongly up through that resistance point. So let's move on down here and take a look at the oscillators. Volume, you can't tell anything from that. Here in the MACD, you can definitely see bottom and basing here pretty much similar to 2009, though 2009 did take a bit longer. We've had a pretty steep move off of that bottom on up through here. We're starting to accelerate with the MACD. That fast line is moving on up pretty quickly. Here, the red, the slow line. So there is separation occurring, and I think it is continuing on up very strongly. Move down here into the histogram, you can see that strength, that bottom and basing here, and then the sharp run all the way on up. I think that we continue on up, and that's simply my opinion about the probabilities. Moving here into the price rate of change, pretty much the same pattern as the MAC. Very strong move off of that bottom and basing. The same with the RSI. We're at a moderate 69.18. We're going to move up into that overbought territory over 80. And I think we might stay there for a little while. Certainly, I think we can stay up above in that overbought territory. Once the stochastics get up there, it looks like they've had a nice bottom and basing and then a run. Not unlike here at the bottom of 2009. Nice run, and that stayed up above that overbought territory for a length of time. It did dip below now and then, but back on above. So I think the probabilities are for the market to continue on up. Looking here at the Williams, pretty much the same thing. We're at a negative 0.82, very strong. Moving back up here to the price chart, one last look. In my humble opinion, we are going to head toward that all-time high. As we get closer to that, we'll talk about whether there's strength enough to move through or if I see any sign of resistance and perhaps a pullback and maybe a correction. because that double top could be severe, but I'm not sure that's what Robert Kiyosaki is looking at. But that's what we need to look at. Stay ahead of the market because the risk is all yours. ChewDog out.